Good day. Today, we will discuss the first chapter of this course, which is Understanding Financial Statements. You may ask, why do we need to study financial statements? Let us put it this way. For example, assume that you are a manager deciding whether to acquire another company or divest of a current division. Or imagine yourself as an equity or credit analyst. How do you assess and communicate an investment appraisal or credit risk report? Very good. Through reading the financial statements. That is the reason why we need to study and understand financial statements. So for this chapter, you are expected to understand how business activities are reported through the financial statements. Second, enumerate the sources of information about a business enterprise. Third, identify the required financial statements and know how they are interconnected. And fourth is to know the nature and significance of the four financial statements. What are these? These are the balance sheet statement, the statement of comprehensive income, and the statement of stockholders' equity and statement of cash flows. So here is the presentation outline. So basically, we have 13 topics. But for this video, I will just discuss to you the first half of this chapter. Okay, for the first topic, how business activities are reported. So to be able to analyze a company effectively or infer its value, it is important that one must understand the company's business activities. And this can be accomplished through the financial statements. Financial statements report on a company's performance and financial condition and reveal executive management's privileged information and insights. And financial statements serve the needs of different users. So the operation of the accounting information system involves application of accounting standards to produce financial statements that provide insights on the business activities of the company under analysis. Accounting information should be used in the business context in which the information is created. Okay? Please understand that all companies without exception plan business activities, finance those activities, invest in those activities, and then engage in operating activities. So business firms conduct all these activities while confronting business forces, including market constraints and competitive pressures. Financial statements also provide crucial input for strategic planning, as well as information about the relative success of those plans, which can be used to corrective action and make new operating, investing, and financing decisions. Okay, so what are the general objectives of financial statements? First, we have providing information for economic decisions. When we say economic decisions, these are taken by the users of financial statements that require an evaluation of the ability of an enterprise to generate cash and cash equivalents and the timing and certainty of their generation. This ability ultimately determines the capacity of an enterprise to pay its employees, suppliers, meet interest payments, repay loans, and make distributions to its owners. Second, providing information about the financial position. Okay, please take note that financial position of an enterprise is affected by the economic resources. So what are these economic resources? First, we have information about the economic resources controlled by the enterprise and its capacity in the past to modify these resources is useful in predicting the ability of the enterprise to generate cash and cash equivalents in the future. Another one is information about financial structure is useful in predicting future borrowing needs and how future profits and cash flows will be distributed among those with an interest in the enterprise. Third, information also is useful in predicting how successful the enterprise is likely to be in raising further finance. Information about liquidity and solvency is useful in predicting the ability of an enterprise to meet the financial commitments as fall due. Liquidity refers to the availability of cash in the near future after taking account of financial commitments, and solvency refers to the availability of cash over the longer term to meet financial commitments as they fall due. Okay. So those are the economic resources that are affected. The third objective of financial statement is providing information about performance of an enterprise. So another important objective of the financial statements is that it provides information about the performance and in particular its profitability, which is required in order to assess potential changes in the economic resources that are likely to control in future. Information about variability of performance is important and useful in predicting the capacity of the enterprise to generate cash flows from its existing resource base and informing judgment about the effectiveness with which the enterprise might employ additional resources. The fourth one is providing information about changes in financial position. So basically, the financial statements provide information concerning changes in the financial position of an enterprise, which is useful in order to assess its investing, financing, and operating activities during the reporting period. This information is useful in providing the user with a basis to assess the ability of the enterprise to generate cash and cash equivalents and the needs of the enterprise to utilize those cash flows. Okay. Now let's move on to the next topic, which is the demand for financial accounting information. So who needs this financial accounting information? First one, we have the managers and employees. Why the managers and employees? For their own well-being and prospective earnings, potential managers and employees need accounting information on the financial condition, profitability, and prospects of their companies, as well as comparative financial information on competing companies and business opportunities. Management uses financial statements to raise financing for the company. to meet disclosure requirement and to serve as a basis for executive remuneration and bonuses for wage negotiations and to meet disclosure requirements. Why employees? Because as an employee, you are a stakeholder of the corporation. So it is just right that you know the financial status of the company because you are working for that. Second one is investors and analysts. Financial statements are used by these parties to decide whether to buy or sell equity shares. Because of course, the very reason why you invest in such company is to maximize your profit, to earn income. So how would you decide? How could you make a decision whether to buy or to sell your equity shares if you don't know the financial status of the company? And where to find it? Through the financial statements. Expectations about future profitability and the ability to generate cash influence the price of securities and a company's ability to borrow money at favorable terms. Other information intermediaries such as financial press writers and investment analysts are interested in predicting companies' future performance. The third, creditors and suppliers. Okay. So why creditors and suppliers demand for financial accounting information? Creditors, example, the banks and other lenders. So they need financial accounting information to help determine loan terms, the loan amounts, the interest rates, and required collateral. Why would the creditors extend loans to the corporations if they don't have the capacity to repay its loans? So, of course, the creditors, for example, the banks, and the lenders need to see the financial accounting information of the company. Suppliers also demand financial data to establish credit terms and to determine their long-term commitment to supply chain relations. Both creditors and suppliers use information to monitor and adjust their contractual requirements and environment with a business firm. The fourth one is shareholders and directors. So financial accounting information are needed by, of course, the owners and directors of the company to assess its profitability and risks, to evaluate managerial performance, and to help make leadership decisions. Take note that as a shareholder of the company or as the owners of the company, you have to make leadership decisions. Also for the directors. So how to make these decisions? What would be the basis? Through the financial accounting information. Because in the financial accounting information, you can assess the performance of the business.